104. General Studies, Mains, Paper 3. Depreciation of Indian Rupee. The price for such transactions is fixed at the time of contract, which is called a forward rate. Forward exchange rate differs from spot exchange rate as the former may either be at a premium or discount. If the forward rate is above the present spot rate, the foreign exchange rate is said to be at a premium. Exchange rate policy. Foreign exchange rate in the market may directly or indirectly be influenced by the action of government in market. Like devaluation. When foreign exchange problem is faced by the country, the government tries to reduce imports and increase exports. This is done through devaluation of domestic currency. Under devaluation, the government makes a deliberate effort to reduce the value of currency of home country. If devaluation is carried out, then the exports will become cheaper and imports costlier. This in turn will help to reduce imports and increase exports. Depreciation. Depreciation, like devaluation, lowers the value of domestic currency or increases the value of foreign currency. Depreciation of a country's currency takes place in freer competitive foreign exchange market due to market forces. Depreciation and devaluation have the same effect on exchange rate. If there is high demand for foreign currency than its supply, it will depreciate the home currency. However, in several countries, the system of managed flexibility is followed. If there is more demand for foreign exchange, the central bank will release the foreign currency in the market from its reserves so as to reduce the appreciation of foreign currency. In recent times, number of factors has led to steep depreciation of the rupee vis-a-vis dollar. India has had chronic trade deficit leading to high CAD and more demand for dollar than supply. Further, recent Eurozone crisis has adversely impacted Indian exports. It has also ballooned due to high crude oil prices and surge in gold imports. Once the rupee begins to slide, it further widens the CAD, leading to further downslide of rupee. Similarly, high inflation makes raw material, services costly for the export-making export. Product less competitive vis-a-vis Chinese export. Recent announcement of U.S. Federal Reserve taperings and revival of U.S. economy has further pushed the outflows. U.S. Treasury bonds are considered the safest investment. During the peak of Greece crisis, the big investors started pulling out money from Europe and investing it in U.S. Treasury bonds, which implied increased demand of dollar. For past few years, Indian government's inefficiency regarding environmental project clearances, land acquisition, FDI in retail, pension, insurance, etc., has led to foreign investors losing faith in Indian economy, resulting in slowdown in FLL inflows. Currency war. Currency war, also known as competitive devaluation, is a condition in international affairs where countries compete against each other to achieve a relatively low exchange rate for their own currency. As the price to buy a particular currency falls, so does the real price of exports from the country. Imports become more expensive. So domestic industry and thus, employment receives a boost in demand from both domestic and foreign markets. Types of currency. There are various types of currency war are as follows. Hard currency. It is the international currency in which the highest faith is shown and is needed by every economy. The strongest currency of the world is one which has a high level of liquidity. Basically, the economy with the highest as well as highly Diversified exports that are compulsory for other countries to import will also create high demand for its currency in the world and become the hard currency. Up to the Second World War, the best hard currency was the pound sterling, pound of the UK, but soon it was replaced by the US dollar. Some of the best hard currencies of the world today are the US dollar, the euro, Japanese yen, and the UK sterling pound.
పొద్దున ఫోన్ చేసింది వినాక ఎప్పుడు ఇస్తాను లోన్ అంటే నువ్వు రా ముందు బ్యాంకు సరే కర్ణాటకలో వచ్చిందంట.
External trade. 105. Soft currency. It denotes the currency that is easily available in any economy in its forex market. For example, rupee is a soft currency in the Indian forex market. It is basically the opposite term for the hard currency. Hot currency. It is a temporary name for any hard currency. Due to certain reasons, if a hard currency is exiting an economy at a fast pace for the time, the hard currency is known to be hot. As in the case of the Southeast Asian crisis, the US dollar had become hot. Heated currency. It is used to denote the domestic currency which is under enough pressure of depreciation due to a hard currency's high tendency of exiting the economy. It is also known as currency under heat or under hammering. Cheap currency. It is a term first used by the economist J.M. Keynes, 1930s. If a government starts repurchasing its bonds before their maturities, the money which flows into the economy is known as the cheap currency, also called cheap money. Dear currency. It is used as the opposite of the cheap currency. When a government issues bonds, the money which flows from the public to the government or the money in the economy in general is called dear currency, also called as dear money. The foreign exchange reserves. India's foreign exchange reserves comprise foreign currency assets, PCAs, gold, special drawing rights, SDRs, and reserve tranche position, RTP, in the International Monetary Fund, IMF. The level of foreign exchange reserves is largely the outcome of the RB's intervention in the foreign exchange market to smoothen exchange rate volatility and valuation changes due to movement of the US dollar against other major currencies of the world. Foreign exchange reserves are accumulated when there is absorption of the excess foreign exchange flows by the RBI through intervention in the foreign exchange market, i.e., receipts and interest receipts and funding from the International Bank for Reconstruction and Development, IBRD, Asian Development Bank.
వానికి తాగు నేర్పించిన దారిలోకి వచ్చిండే
106. General Studies, Mains, Paper 3. Types of foreign investment. Foreign investment can be divided into two parts, which are as follows. 1. Foreign direct investment, FDI. It involves overseas equity investment projects in India with the objective of directly managing business in India. This investment can be greenfield, in which money is invested in new projects, or brownfield investment, in which investment is made in existing projects. Though these investment carries an explicit profit motive and business orientation with long-term interests, they also offer unique blend of resources, knowledge, technology, and professionalism in management techniques. FDI adds to the production capacity of a nation and is considered the most preferred and stable form of foreign capital inflow because it does not involve any repayment obligation on the part of the country concerned. Routes of foreign direct investment. Foreign direct investment in India is allowed under the three routes. Under automatic route, FDI is allowed without prior approval either of the government or the Reserve Bank of India in all activities, sectors is specified in the Consolidated FDI Policy, issued by the Government of India from time to time. Under FIPB route, FDI in activities not covered under the automatic route requires prior approval of the government, which are considered by the Foreign Investment Promotion Board, FIPR, Department of Economic Affairs and Ministry of Finance. The government has announced the scrapping of FIPB in the Union Budget 2017-18 to ease inflow of FDI. Under NRI route, Government of India provides various incentives to NRIs, including organizing annual events to motivate them to invest in India. In certain sectors, they are permitted to have 100% FDI. Government measures to attract foreign direct investment. Construction, maintenance and operation of rail infrastructure are made eligible for 100% FDI under automatic route except for security sensitive area. The definition of NRIs was amended to accommodate person of India origin, PIOs, and overseas citizens of India, OCIs. Investment made by NRIs is deemed to be domestic investment at par with the investment made by residents. FDI up to 100% is permitted under the automatic route for manufacturing of medical devices. Black Circle 100% FDI is permitted in construction development under automatic route subject to certain conditions such as floor area restriction, minimum capitalization, etc. Government has constituted dedicated funds and bodies for attracting FDI such as NILF and Invest India respectively. Several reforms has been initiated to provide ease of doing business to foreign investor. Future of liberalization of foreign direct investment. In defense, the influence of this move on Indian defense and economy are Black Circle FDI in defense sector could bring in foreign firms that wish to take advantage of India's lower cost labor base. It will improve India's balance of payment position and bring down the import of defense equipment. This will reduce the pressure on rupee. Black Circle small and medium enterprises could benefit here as they are all looking to get into the global supply chain but lack capital and technology. Hence, the SME sector will get a big boost in the long run. India is dependent to a large extent on foreign sources for meeting its defense requirements, and they can stop supplies during times of war. There is a need for setting up of defense manufacturing units in India and ensure self-sustenance. Development of military-industrial complex in India, which will increase collaboration between military, academia and industry, leading to higher industrial growth.
ఏమంట
External trade. 107. It will promote indigenization, make Indian defense equipment globally competitive along with high technology base and expertise will be developed in the country. Development of industrial employment in India and increase in research linkages of defense industries to commercial aspects as well. Foreign direct investment in retail in India. Retail accounts for 14% of GDP and employs 9% of the workforce, next only to agriculture. About 95% of it is unorganized retail. 2 is argued that in other countries like China, Poland, Brazil, organized retail is 20 to 25% and entire retailing sector accounts for 20 to 25% of the employment. This means higher the organized retail, higher the employment opportunities. However, this argument is flawed. In India, other activities may be more labor-intensive. Also, organized retail accounts for 5% of share in retail yet employs only 1.25% of the people engaged in retailing. This clearly indicates that it is less labor-intensive. It is argued that increasing the fill in retail would mean that the unorganized retail would go out of business and result in loss of jobs. It is feared that such big stores will solely promote more consumerism and thus affect savings in the economy as a whole. They may acquire monopoly status in consumer-oriented goods, resorting to consumer exploitation. However, there are benefits also. The foreign companies have the knowledge, experience, and would bring in best practices. They will provide much wider choice sell. They follow customer-first policy. They would provide quality products at competitive price. They believe in building their own supply chains, which are highly employment-intensive. Rationale for allowing foreign direct investment in multi-brand retail. A proposal was put forth by earlier government to allow 51% FDI in multi-brand retail. Such companies will have to invest a minimum of $100 million, out of which at least 50% should go in back-end infrastructure development like storage and logistics. There are gross inefficiencies in current supply chain. The number of intermediaries is high and investment in logistics and storage is minimal. Though India produces 230 mt of fruits and vegetables, our total cold storage capacity is just 25 mt. As a result, there is a lot of distressed sale by farmers and wastage. Though FDI in cold storage is 100% through automatic route, in the absence of iron-end retailing, inflows have been negligible so far. It will help in modernizing agriculture and marketing in India by bringing new management practices and technologies. The direct employment generated by the organized retail sector in India over the ensuing 5 years will be close to 17 millimeters. The fear of loss of livelihood by local Kirana stores serves as basic Shikaizen against FDI in organized retail. Since local Kirana stores enjoy proximity and flexibility, providing personalized services, they have unique advantage over organized MNCs. Further, given the behavior of Indian consumers where consumables are bought on a daily basis, the fear of Kirana stores is based on misplaced apprehensions. 2. Foreign indirect investment, FII. Foreign portfolio investment, P, as it is called, is predominantly in the stock markets and in corporate debt and government securities. Their sole objective is to hook profits on investments made. These investments are highly volatile and of short-term in nature. Further, they also carry a repayment liability as against investment owed to FDI. Such investments are also known as foreign institutional investment. India's attempt in opening up for foreign indirect investment has been cautious and gradual. Though sectors such as infrastructure, power, pharmaceuticals, etc. have been permitted, 100 FDI sectoral caps have been imposed in insurance, banking, pension, etc. FDI in limited liability partnerships, LIPs. The government has allowed FDI in LLPS in the open sectors, i.e. sectors where 100% FDI is already allowed through automatic route. In case of LLPS, however, the investor will have to take government approval first. Sectors like agriculture, plantation, media and real estate are not open to it. 108. General Studies, Mains, Paper 3. Foreign Portfolio Investment in India. Foreign Portfolio Investment, FPI, flows have been the most volatile component of capital flows in India. It plays an important role in determining the overall balance of payments. During the Asian crisis as well as during the recent subprime crisis, it was the huge reversal of FPI flows that led to deterioration in the overall balance of payments. Government measures to boost external trade. Under the Foreign Trade Policy, 2015-20, government has taken several steps, including tax refund scheme and enhanced credit to exporters, to boost external trade. Few of them are listed below. Merchandise Export from India Scheme, MACE. It was introduced in 2015, which incentivizes merchandise goods exports of over 8,000 items. Under this scheme, exporters get duty credits at fixed rate of 2 to 5% depending upon the product and target country. Nirvat Rin Vikas Yojana. This scheme was launched to provide enhanced insurance cover and reduce premium for small exporters. This scheme will enable reduction in overall cost of export credit, including interest rates especially to MSMEs. 1. Trade Infrastructure for Export Scheme. This scheme was launched from financial year 2017-18 with the objective to assist central and state government agencies for creation of appropriate infrastructure for growth of exports from the state. The scheme provides financial assistance in the form of grant and aid to central, state government-owned agencies for setting up or for upgradation of export infrastructure as per the guidelines of the scheme. IV, Service Export from India Scheme. This scheme was launched in 2015 under Foreign Trade Policy. Under this scheme, service providers of non-FIDE services are incentivized in the form of duty credit scrips at the rate of 3% or 5% on their net foreign exchange earning. These C scrips are transferable and can also be used for payment of number of central duties, taxes including the basic custom duty. V. Agricultural Export Policy, 2018. With stable trade policy regime, it aims to double agricultural exports from present $30 billion United States dollars to $60 billion United States dollars by 2022. It aims at promoting value-added exports besides focusing on agricultural clusters such as AGN Export Zone, EASE. The policy will also focus on providing infrastructural and logistic support, marketing and promotion of brand India and attracting private investment in export-oriented activities and infrastructure. Important regional trading agreements and their implications on India. 1. Regional Comprehensive Economic Partnership, RCEP. RCEP is a proposed comprehensive free trade pact among 10 ASEAN countries and the plus 6 partners with which ASEAN has free trade agreements, FTAs. The plus 6 partners are Australia, China, India, Japan, South Korea and New Zealand. The RCEP is an ambitious project which for the first time intends to bring Asia's 3 biggest economies, China, India and Japan, into a regional trade agreement. It includes trade in goods and services, economic and technical issues, intellectual property and dispute settlement mechanism. Benefits for India. It is particularly important for India as India is not a member of other 2 groupings, Transatlantic Trade and Investment Partnership, TTIP, and Trans-Pacific Partnership, TPP. Such trade pacts would help India to increase its share in the global trade. India is aiming to increase its share to 3.5% by 2020. Indian service sector IT, telecom, BPOs, KPOS and other skilled services like banking are particularly likely to accrue benefits. It is helpful to Government Act East policy initiative as well. It will immensely help in the overall development of northeastern region. It will bring India closer to ASEAN. External trade. RCEP will provide for better integration with East N. 109. Southeast Asia countries. It will bring more investment in India, which will enhance employment opportunities. However, with increasing openness in the economy, it can affect Indian industries as more and more products will freely Indian market with cheaper rates and tariffs. It can also harm Indian SME sector. India and RCEP. In the RCEP summit in Thailand, India decided not to analyze the RCEP trade deal owing its concerns over lowering and elimination of tariffs on products from other countries.